All right, let's dive in. Today we're talking about a company that's probably invisible to most of us, but is absolutely essential to the global economy: Air Products. Now, this is a story of an old-school industrial giant that suddenly decided to go all in on a massive, some might say crazy bet on the future of energy. It's a company at a real crossroads, so let's break it all down.
So, just to get a sense of the scale we're dealing with here, Air Products, ticker APD, is a more than $60 billion company. We're not talking about some small niche player. This is a heavyweight, a true cornerstone of the industrial world. And when a company this big makes a move, believe me, it sends ripples across the entire economy.
Okay, so here's how we're going to tackle this. First, we'll look at what makes this company a giant. Then, we'll get into their huge bet on hydrogen. We'll cover the strain and the risks that came with it, and wrap up with the big question every investor is asking right now.
So for our first section, let's get to know this giant. I mean, for something like 80 years, Air Products has been the company supplying the essential stuff. Think oxygen, hydrogen, nitrogen, to just about every critical industry you can imagine. We're talking steel mills, electronics manufacturing, even hospitals. They're in about 50 countries, so yeah, they are literally woven into the fabric of the global economy.
And you can really see that global footprint right here in the numbers. I mean, look at this. The Americas are their biggest playground, making up over 40% of their sales. But they're not just a one-trick pony. Asia and Europe are massive markets for them too, giving them this really diverse stream of revenue from all over the world. This is a truly international beast.
Now, one thing you got to understand about this business is that it's a classic oligopoly. It's basically a three-horse race. The barriers to entry are just gigantic. You can't just wake up one day and decide to compete with these guys. You need billions, and I mean billions with a B, just for the plants and pipelines. It's an incredibly exclusive club with a very deep moat around it.
Okay, so let's look at the other members of that exclusive club. You've got Linde, which is the undisputed heavyweight champion, and it's priced like it. See that higher PE ratio? The market gives it a premium. But then you look at our company, APD. It's trading at a cheaper valuation, and here's the kicker. Look at that dividend yield. It's way higher. And as an investor, you have to ask, why? Well, that higher yield is basically the market paying you to take on the risk. The risk of what? Well, the risk of that massive hydrogen bet we keep talking about.
All right, section 2. So you might be wondering, how does a company that we're now describing as a huge risk taker build this reputation for being an unshakable, stable giant in the first place? It seems like a contradiction, right? Well, the answer is in its core business model. It's like a financial fortress, and it's built on this really smart idea they call the barbell.
Okay, so what is this barbell thing? It's actually pretty brilliant. Think of it like this. On one end of the barbell, you have pure, unshakable stability. They literally build a gas plant right next to a major customer and sign them to a 15, even 20-year contract. These are take-or-pay deals, which means the customer pays whether they use the gas or not. It's almost like a utility, just rock-solid, predictable cash flow. Then on the other end of the barbell, you've got the upside. These are shorter-term deals that are tied to the ups and downs of the economy. So when things are booming, they make a lot more money. You put those two together, and what do you get? A fortress foundation with a shot at big growth. And the result of that fortress model? Well, it's just incredible consistency. I mean, get this. Air Products is what's known as a dividend aristocrat. That means they have increased their dividend to shareholders for over 40 consecutive years. Think about that. Through recessions, booms, busts, for 4 decades straight, they've paid their investors more money. For anyone looking for stable income, that is a track record that's pretty hard to argue with.
But, and this is the big but, that leads to the multi-billion-dollar question, doesn't it? If you're this big, stable, mature company, how do you actually grow? I mean, how do you really move the needle in a meaningful way? Well, for Air Products, the answer was to stop playing it safe and to take one of the biggest, gutsiest swings in the company's entire history.
And that brings us to our next chapter, the Great Hydrogen Bet. This wasn't a small experiment. This was a massive company-defining pivot. Air Products essentially said, we're going to go all in on clean hydrogen. We're already a leader in hydrogen today, so we're going to leverage that to absolutely dominate the low-carbon energy market of tomorrow.
Now, to really get what they're doing, you just need to know 2 colors, blue and green. Green hydrogen is the holy grail. You take water, you use renewable electricity like solar or wind to split it, and boom, you get hydrogen with 0 carbon emissions. It's the ultimate clean fuel. Blue hydrogen is more of a transition fuel. You make it from natural gas, but, and this is key, you capture the CO2 that's produced, so it's low carbon, not 0 carbon.
And when I say they bet big, I'm not kidding. The scale here is just
Breathtaking. We're talking about an $8.4 billion green hydrogen facility in Saudi Arabia called NEOM, a $4.5 billion blue hydrogen plant in Louisiana, another huge one up in Alberta, Canada. These are not little pilot projects, folks. These are world-scale, first-to-their-kind mega projects that could literally define the future of energy.
But you know how this story goes. That kind of ambition, it always comes at a price. Trying to build all of these massive projects at the exact same time started to put an immense strain on the company's finances. And this introduced a whole new level of risk, a risk that investors and the big credit agencies simply could not ignore.
So here's the problem in a nutshell. The amount of money the company was spending on these new projects, that's called capital expenditures or CAPEX, started to be more than the cash it was bringing in from its normal everyday business. That's a situation called negative free cash flow. And for any investor, that is a huge flashing red light. It's like spending more on your credit card every month than you earn in your paycheck. You can't do that forever.
And believe me, it wasn't just Wall Street that got nervous. The big credit rating agencies, we're talking Moody's and S&P, the ones who judge a company's financial health, they both sounded the alarm. They downgraded their outlook on the company to negative, basically saying, whoa, hold on, this company is spending way more than it's making, and that's putting its financial stability at risk.
Now, the company had an answer for all this, of course. Their argument was based on something called the J-curve of investment. The idea is pretty simple, actually. You spend a ton of money up front, so your returns take a nosedive for a while. That's the bottom of the J. But then, once all those shiny new projects are built and start making money, your returns are supposed to rocket straight up, forming the long part of the J. The entire investment case, their entire argument, hangs on that final payoff.
Well, eventually, the pressure just became too much to bear. By early 2025, shareholder patience ran out, and a new CEO was brought in to right the ship. And this new team, they moved fast. They immediately bailed on 3 projects, taking a massive $3.1 billion write-down. And they slammed the brakes on that huge Louisiana project, delaying it to try and find partners and share some of the risk. It was a crystal clear signal the era of spending at all cost was over. Capital discipline was back in charge.
So, where does that leave us? All of this turmoil, this huge bet, this change in leadership, it all brings us to the final, critical question for anyone looking at this company today. Do you buy, sell, or hold? What's the real story here for an investor?
Let's lay it all out. On one hand, you have the bull case, the optimistic view. You've got that rock-solid core business we talked about, that 40-plus year track record of dividend hikes, and now a potential first-mover advantage in hydrogen with new leadership that's focused on discipline. That sounds pretty good, right? But then there's the bear case, the pessimistic view. And it's a scary one. These projects are insanely complex with massive execution risk. They don't even have guaranteed buyers for all this hydrogen yet. And on top of that, the company's finances are still pretty strained. It's a real tug-of-war.
So, if you're watching this company, what are the key things you need to be looking for? Here's your cheat sheet. Number 1, project execution. You need to watch for any updates on NEOM and the other big projects. Are they hitting their milestones or are there delays? Number 2, they need to sign what are called offtake agreements. That means locking in long-term customers who promise to buy all this hydrogen. Number 3, watch that free cash flow. Is it starting to move back towards zero? And finally, number 4, keep an eye on the return on invested capital. Is that J-curve finally starting to curve up? Those are the metrics that will tell you which way this story is going.
And that leaves us with the ultimate question, the one that everything boils down to. Is Air Products a visionary company, building the essential energy infrastructure of tomorrow and setting itself up for another century of dominance? Or has it made a colossal blunder, betting the entire farm on a future that just isn't ready to happen yet? The answer to that question isn't just going to define the stock price. It's going to define the very fate of this industrial giant.